David, let's just start with you. Just a brief introduction of yourself and Merlin.
So Merlin is a REIT, SOFIMI in Spain, operating both in Spain and Portugal. At this point, about 90% of our assets are in Spain and 10% in Portugal, predominantly in Lisbon. And that covers really three main asset classes. We're involved in offices, which represent 50% of our activity. We're involved in warehouse logistics, which is today approaching 20% of our activity. And we're also involved in retail, which is about 18% of our activity. And the remainder is a net lease portfolio that we have with BBVA. I am the CIO for one of the three founders and the CIO, Chief Investment Officer, for Merlin.
Antonio, maybe just a quick introduction of yourself as well.
Yes, of course. Many thanks. Iberian Property is part of Iberia Group, which publish in Portugal a Vida Imobiliária, in Spain Observatório Imobiliário na revista Centros Comerciales, and we have this overall publication in English for the Iberian investment market, Iberian Property, where you can find all the deals and transactions in Iberian property data, and we are pleased to be partners of Real Asset Media and to organize this kind of events with you. It's been a pleasure.
Francisco, maybe just a quick introduction of yourself and Norfin.
I'm Francisco Sottomayor. I'm CEO of Norfin. Norfin is an independent asset manager in Portugal. We manage roughly 1.4 billion in AUMs. We do different things. I think 1/3 of the portfolio is a CRE yielding, 1/3 is CRE residential, and 1/3 is development, mixed-use development. So I've joined in May with a difficult role of replacing the previous founder and CEO, João Brion Sanches. So the company has been incorporated for 20 years roughly.
Thank you. José.
Hello everyone, and thank you very much, Richard and Antonio, for having me here with this excellent group of speakers. My name is José Llovet. I am the CEO of Commercial Real Estate in Grupo. Grupo at a glance, very quickly, a company of 50 years, which is in 6 countries today, has 300 employees, and actually, we have 4 billion of assets under management in these countries. You know that we are developers, investors, and are becoming more and more investment managers. We are doing resi for sale, resi for rent, logistic, retail, and also we have an eye in a new business. We are looking very, very close to the projects and to the new formulas, co-living, co-working, all these words that we are saying. And we founded the first SOFIMI in Spain in 2014, La España, that it is quoting in the Spanish stock exchange.
Perfect. Thanks very much. Pedro.
My name is Pedro Coelho, CEO of Square Asset Management. Square Asset Management is the largest independent asset manager in Portugal. We manage about 1.4 billion euros for private and institutional investors spread in all sectors. And we manage the largest open fund in Portugal, which has about 850 million euros without leverage, and that won the MSCI award over the last 10 years in a row as the highest performance balanced portfolio.
Perfect. Great. Thank you. Rodrigo.
I'm Rodrigo Cortés. I'm the head of fundraising client development at Azora. The Azora Group is an independent asset and investment manager based in Spain. We were founded in 2003. We currently manage around about 4 billion euros of assets under management, and we're structured around, let's say, 3 core verticals. The first one is the living space, where we are very strong and are in fact the largest manager of purpose-built rented resi in Spain. And we're also doing senior housing in that space. Then we're also, another key vertical is hospitality, where we've raised a number of different vehicles to invest in that. And then we're also now investing in logistics, specifically last mile logistics, but we also have strong experience in the past in offices and student housing. We're a completely vertically integrated platform, so we do everything from acquiring land, helping through development, etc., and all the way through to property management. And on the back of that, we're a pretty broad platform with 240 employees which goes through the full spectrum of investment.
Super. Thanks very much, Rodrigo. So a really interesting group of speakers here, lots of expertise on the market. And this panel particularly looking at, I guess, trying to get what the investor's view is on the market and the outlook for the market. Maybe just starting with you, David, in terms of Merlin, what are you seeing as the sort of major trends influencing, or you're expecting to influence your company's activity in 2021?
Just to, if you think about where we've come from, obviously after the pandemic, I think everyone just went into management mode, right? It was all about how do we deal with ensuring we're keeping our employees safe, how we make sure that we're doing things with our buildings to keep our tenants safe, and that really and then in retail particularly, how do we make sure that we do what we can to work with our tenants to help them survive. That's the approach we took. We said we're going to partner with them in effect, as opposed to make it a litigious enforcement of contract approach. We said, that this is a situation that is obviously outside of the responsibility of anyone. So let's try to make sure that we do what we can so that we both survive well. And we felt that was much better for the long run than getting into a very kind of litigious situation. And I would say that really dominated the good part of 2020. Now, as you look at things, and the vaccine again was the game changer, which I think everyone had always thought it would be. And so those countries that are ahead in terms of vaccination are also looking in terms of being ahead in opening the economies. But I think when you look at what people are saying now, it's anywhere between summer, autumn to end of year. But by the end of the year, we should have most economies kind of up and running and opening again. Not that things will be back to normal, because I think we'll have a new normal, if you will. But you will now you'll now have a vision about where things are going. And so people are right now starting to take decisions about where do they want to be. And so from our perspective, I think the areas that we still like and always have are logistics. We think that we're the largest logistics operator in the Iberian Peninsula. We have almost 1 million square meters of space under development right now, in addition to what we already own. So we're long that space. We've always been long that space. And I think with the tailwinds that we see, we'll continue to be long that space. We too are, and we're across the board in that, right? I think it's everything from large box distribution, cold storage, cross-docking, and last mile. You have to touch every piece of it because you want to be able to serve your client across the entire spectrum. We're geographically diverse in that, we're in Lisbon, Sevilla, Basque Country, Valencia, Barcelona, Madrid. We call it a pan-Iberian network. And so we will continue to self-develop. We're not buying because I think the market has gotten a little crazy. Yields in the UK now, yields are sub 4% for logistics, which boggles the mind for anyone who's been involved in the logistics space for a long time. And you're seeing deals done at sub 5% in Spain. So the acquisition market, I think, has gotten a bit crazy. So we'd rather develop at a 7.5% to 8% yield than buy at a 5%. And we have the land bank to do that. So that's really what we're doing. So still really like that space. And then there's some add-ons, which I think you'll hear about as we talk about some other, what I would call adjacent to the logistics activity. I won't talk about a lot now because we haven't gone public with it, but other, what I think are very complementary businesses that go next to logistics. Last mile, we're looking at integrating all of our activities. So we're running last mile logistics out of the office buildings, parking garages of our office buildings. We've got pilots working with GLS, with Revolt. We're running them out of our shopping center parking lots. So we're integrating last mile logistics. It's not just a logistics activity. It's an activity where your shopping centers and your office buildings, I think, can play a role because they tend to be very centrally located. So they're quite attractive. And that activity in those two, office and retail, tends to happen during the day. So during the evening with no activity, you can transfer that over to logistics. So we're big on that. Offices, we still feel, I think, quite optimistic about offices. It will change, but the work from home phenomenon, I think every time you talk to someone about work from home, it gets less and less of a appeal or an issue. When it first came out after the pandemic, everyone's going to work from home forever. And you saw companies like Twitter say, you never have to come back to the office again, or Facebook, you'll never have to come back to the office again. And Facebook goes out and leases 750,000 square feet in Manhattan. I wonder what those people are going to be. I wonder what that square footage is for if no one's ever going to work in the office again. So I think it's been a little overdone, this whole work from home. And now you hear people talk about the hybrid model, which is some days from home, some days close to home, some days in the office. And I think that's the direction companies seem to be moving in, which means you're going to have a bit of a more dispersed workforce. The whole idea of center city only, I think, is changing. Markets that people worry about, San Francisco, London, New York, high cost, long commute markets will be more affected. I think Madrid and Barcelona and Lisbon, relatively low cost, easy commute markets, there's less of an impetus for work from home. So you'll see that it will happen, but it will happen to a much lesser degree than I think you'll see it in some of these larger high cost markets. And so we're looking at our portfolio in that way now, where we have both center city, but we also have new business area. And so I think that will become more appealing. And we're also looking at growing our flex space, because flexibility is something that all tenants were demanding pre-COVID. And like many trends, that's only accelerated by COVID. So we're making an extra impetus and a push in our flex business to provide more spaces within our own buildings to marry that with traditional. So you can go to any tenant and say, if you want traditional 5-year lease, you can do that. You want flex by a year, we can do that. You want daily, space, we can do that. You want to rent meeting rooms, we can do that. We've got a broad array of products that we've developed, and we've developed the technology to allow us to deliver that. And that's so we still are very bullish about office, but you have to make these adjustments and changes to address the market. Retail, I'll tell you, it's going to be a challenge everywhere. The whole move to a lot of people who never would have thought of buying online before, we're now forced to. So the adoption rates are increasing, and that's going to put pressure. We still believe that long term, it's urban and dominant centers that we the ones that will survive. But the pressure on retail in general, I think, will continue to be with us for a number of years.
Okay, good. Lots
long-winded, but that's my survey course on real estate.
Yeah, lots to pick out of that, I think, David. Pedro, just pick up some of those key things, I guess, around what you're looking at in terms of strategy for Square Asset Management. What's influencing your business over 2021? How strong a recovery are you expecting to see? Because there's a lot of discussion around the economy, obviously, and the economic impacts. How fast and strong a recovery are you expecting for your markets?
I would say that on a global basis, we expect the economy to recover quite quick after the vaccine is implemented. And we have to mention, as we all know, that in Europe, vaccine is a little bit slower than in other countries. So it's a little bit difficult to understand a little bit where it's going to be the turnkey point. But I would say, not as David, I think we are going to come back to the old normal. Of course, on a probably slower basis, meaning on next winter still we are going to have masks and etc. But probably then after, I think we're going to come back to the old normal. Of course, with some impact in the different sectors on real estate. And so, for example, probably going to the ones that are more suffering now, everything that is connected to tourism is the sectors that are more impacted nowadays. But on the other hand, we think that are the ones that are going to recover much faster, because the starting point is much slower, as the normal. But I would say, for example, for an aggressive investor, probably that's where it is, or they are the best opportunities to buy now, because there are a lot of distress on that assets, meaning hotels, some high street retail on the best streets in the tourist areas, and of course restaurants, other things connected to tourism. Just going to the other opposite point, as David was mentioning, so logistic, that was the kind of the ugly duck of the market on the old times, because they are just boxes outside of the city, so it's not sexy at all. Nowadays it seems to be the best, brightest in the world. Everybody wants to go to logistics. I think that that logistics have, of course, an impact on the e-commerce, even in Portugal, but I think the impact is very slower and very low depending to the markets, because Portugal, the full population is about what are the big cities. So you cannot build just logistics near each city of Portugal. So my view is that retail is not going to suffer as much as in bigger countries with big population, because the brands are going to take opportunity of the stores they have already spread to be either the picking point or the places to make the delivery, while the logistics is going to stay the same one as it is today. And so in that sense, my view is that, for example, main shopping centers, meaning the ones that are located near the big cities, etc., although due to the main investors don't like to look for them as an investment, but from a yielding point of view, it's still very rewarding to have that. And so Square, over 2020, we bought assets in retail, in offices in Lisbon and Oporto, in logistics, and in the assisted living. So we spread a lot as usually, because as we manage the biggest fund in Portugal with about 25,000 unit holders, so small savings, we have to be very defensive and protecting the saving of the people on the longer term. And in that sense, it's very important to diversify sectors and geography. So finally, I would say that the big question mark over this and the big discussions are, as David was mentioned, the offices. So there are the ones that are saying that this is going to back to the normal. And so people, and of course, I think, and I feel that people like to come back to the office. On the other hand, some say that, well, the teleworking is going to stay, and so people are going to be more spread and etc. Probably it's going to be a balance. Companies are nowadays more organized to have people working from home, and so probably a balance, as again David was mentioning, about the connecting point in Lisbon and Oporto are much quicker than in the big cities. So I think in that sense is more attractive for investing in Portugal. But I mean, as a final, I would say that what we all know is that interest rates are on the lowest point and are going to stay as like they are, I would say, for the next decade. And so real estate is going to become a very important asset class on the portfolios.
Perfect. Let's go on the risks your activity faces. There are economic risk, political risk, regulation risk, and now an health crisis risk. José Maria Llovet, and afterwards with Francisco, what are the main concerns, the major risks you foresee on your activity?
Yes, well, this is much important. I mean, we have been participating in different webinars and in different meetings for the last months. I remember one that I was with Richard, and we were talking about the acceleration of the trends. We were talking about the big wall of money that's supposed to be already here, investing in all sectors in the economy, in retail, but in offices as well, and in logistics. and also the focus of the investor that was going to be, as we are verifying now within this conversation, that we're going to be logistic, residential for rent, and I will add supermarkets. But I mean, all these predictions probably were correct. However, the scenario is very sensitive. It is difficult to read. We are still in a road. It's very winding. We have more visibility, but we still have a lot of uncertainties ahead of us. So, to me, there are 2 points. You have already mentioned other things, but I would like to remark 2 points that are going probably to make the recovery a little bit slower. First is the increasing difficulties for financing. We are seeing the banks being more, let's say, selective and fixing some conditions that are probably more difficult to be met by the developers and by the investors. And I think that this is going to affect to the growth of all sectors and all subsectors in the real estate. The second point that I want to remark here, it is a little bit uncomfortable, but at the end of the day, we are seeing a lot of political debates that probably are creating some confusion. And we have to take into account, everybody knows that we are in a very difficult moment, and what we need is clarity, and what we need is support. And in particular in Spain, we are seeing a lot of different rules in the different regions that make you feel a little bit lost of what you can do, what you can't do. Can you open your shopping center in Catalonia? Can you open in Galicia? Can you open in Madrid? So this is being very, very difficult to manage. And just for completing my point here, I would like to talk about, that I am the retail person. No, I am always, this is my 30th year in the retail industry in Europe, mainly in Spain. No? And I think that this is a good moment to make a kind of segmentation of what is retail, because I have heard Mr. Bruce and Pedro mentioning shopping centers, and retail is a wider industry. We have shopping centers, we have food retail, and we have retail parks. In shopping centers, I have to say that we, in the centers that we have seen the people coming back to the centers the time that they have been fully open. Unfortunately, not many times in the last 2 months, and especially in some regions where we have seen some kind of discrimination for this industry. The group of owners of shopping centers and investors of shopping centers, we have been working very hard in supporting tenants. We have granted a big amount of rent reductions, because what we wanted to have is to secure the occupation, the rent collection, and the viability of retailers. I think it is the moment now to see the governments, the national and regional governments, supporting the small companies that was mentioned in Debbie before. Medium size and big size are more or less covered, but we need to make a specific effort for these small companies that have been creating wealth and employment for many years now. And maybe it is time for the whatever it takes of Mr. Draghi, some years ago. We need to support these companies. And then shopping centers, we need time to see what is going to happen, what is final impact, operational and financial. So it's going to take time. Therefore, the investment activity is going to be not very big. But the other two, and very quickly, the other two subsectors that I wanted to mention are food retail. It is fair to say that food retail now, they have proved a strong resistance. We have seen increases of 2 digits in the turnover of the biggest supermarket chains in Spain. And we are seeing specific vehicles buying big amounts of supermarkets all around Europe and the US. We see, and we have some experience in this, that this is a very active market, and this is going to grow, and the prices are going to get higher. So we see a lot of security. And now for completing my intervention here, I would like to give you some information about retail parks. Retail parks is another specific subsector in the behind the umbrella of retail. Is a segmentation in which we have to focus the people when they talk about retail. We have to focus the people in the different sectors. Retail parks have been working very well. They have demonstrated their strength as well. Visits and sales had almost recovered by the end of 2020 compared with same months after the closing. And in this here, I would like to remark as well that most of the tenants are very big companies, all of them an omni-channel, because we are talking about digitalization, that these guys have been investing huge amounts of money during the last 10 years in digitalization, and they are online leaders as well. And for this reason, I think that the retail park sector is in from the investment point of view, is something that is going to come back. I would say my prediction at the end of this year, and maybe before, maybe around autumn, we could see some transactions in this sector. But in general, I see a strong recovery in the investment of real estate. I am quite optimistic.
Francisco, on your view, when you need to report to your US and UK shareholders, and when they ask about risks of your operation in Portugal, what is your answer?
I think there's been a significant shift in the way we look at risk. I mean, there's a new risk which none of us ever thought it would impact the market, which is the health risk. And I think this is particularly important when looking at, for instance, the tourism market, which is one that we are particularly focused on. And I think you have to be, if you're investing in Portugal and Spain. It's a sector that you must have a view on. I'm sure that, talking to people over this last year, I think when the first confinement ended in China, we were talking about revenge shopping, and I see people talking about revenge tourism or revenge traveling. People want out. People want to be able to go to the sun or to go to ski or whatever. So I think this for the tourism sector in Portugal, and of course also in Spain, I think the health risk is a key one, and I think it's one that is key for when you look at a country like Portugal, in which the tourism sector has such a huge weight in the economy, and it's I think, in my view, a big part of the explanation of what happened to Portugal over the last few years. I think it's a very important one. Then I think, every time we all look at, the different financial measures and that we see coming, from every corners of the earth into the economy, I think our immediate thought comes to who will be paying for all of this. And I think so the fiscal risk is something that we should be very mindful of, especially in Portugal, where we know that every time additional taxes are required, the real estate sector is always an enticing client to produce the necessary taxes. So I think this is also a risk. Then looking, in detail into Portugal, I think there's a political risk, at least in the city of Lisbon. We'll have elections in October. And we do know that one of the main concerns that we have when we look at developing in Portugal is the licensing system. And we all know that, elections halt most of the licensing processes for a few months before elections and for a few months after elections. So this has a very significant impact, because it's almost a full year in which very little happens. Let's see if this time it's not that difficult, but for me it's a concern. And then, of course, relating to all of these, both the health, etc., is the cost of construction, which is continue to escalating, which is for any developer is a concern. And then, lastly, but certainly not least, I think there's bound to be a rebound in the economy. I agree with what Pedro Coelho said. We share a similar view, but we do think that the banks will suffer. And when the banks suffer, the real estate market is impacted. I mean, if there's no financing for people to buy houses, if it's more difficult, if there's less financing for people to develop or to invest, then the market is bounded to be impacted. And for me, this is one of the big question marks: is how will the Portuguese banking system react to the seismic situation that we'll be living once you disconnect all the support measures that are now in place to the companies, especially in the tourism sector, but not only in the tourist sector. I mean, if you look at what's been happening to the cities of the main cities in Portugal, everything is closed down. If you look at what's happening in the Algarve, everything is closed down. This will have significant impact on everything that happens across the country. So these are, I think, our major concerns. We're looking heavily into the tourism sector. We're looking heavily also into the residential sector, which is an important one for us. And we see, dislocation in both. I mean, we've been discussing heavily who will make a faster comeback. Is it the sun and beach, or is it more urban destinations? So there's a huge set of question marks. But I think in that respect, the health risk will play a very important role, especially for a more peripheric country like Portugal. I think there's a huge question mark around everything that has to do with the aviation sector and how it can impact a destination like the Algarve or a destination like Lisbon. So these are question marks and risks that we will continue to take a view on.
Many thanks. Rodrigo, you are head of fundraising in Azora. My question is, where you are picking up the money, what kind of investors, in what kind of locations, is core money still available, or this is the time to have more opportunistic money?
The first point to make is, if we compare where we are now to, let's say, the previous crisis that we had in Europe, so the great financial crisis in 2009, and we think about where investors are in their mindset, I think if we go back to those days, we saw in Iberia how institutional capital coming in from outside of the region was effectively cut off from 2009. Mostly to 2013, we did have some opportunistic money coming in 2011, 2012, but most of the institutional money came back in 2013 onwards. And I think the economic situation in that context and the sector situation in that context was substantially worse than where I think we are now, and at least where I think investors view us to be now. I think the authorities have reacted much faster and in a stronger way than they did back then, in a more coordinated way. There's a fair amount of money coming from Europe to both Portugal and Spain. And then on a sort of domestic basis, I think the leverage levels of households and the sector in general are at a much better place than they were. And I think this all sort of leads to the trends that I've seen in the last year in my investor interactions. I think, leaving to aside probably the first 3 months of confinement, so from March through to June, the level of investor interaction that we've had, and even throughout those months, the level of interest in looking at Spain and Portugal to invest has been huge. I mean, probably I had more investor interactions from March through to July than I would usually have in 6 months when I could travel by plane. And I think that's sort of been reflected in, if you think of the depth of the GDP fall that we had last year and the stress that we've been through, the fact that there was, I mean, just in Spain, close to 8 billion euros of investment into real estate, which is admittedly below 2019 levels, but it's still way above anything we had from 2009 to 2013. That sort of speaks to the level of interest that we still have for investment. I think the perception generally as to where Iberia sits in investor portfolios has also evolved. I think we continue to be probably not considered core, but I think there are very few investors now that don't consider having Iberia within their sort of portfolio allocation. and I think that case in point to that is the fact that, I mean, we managed to raise 680 million euros in our new hospitality fund in June, so post COVID. And we raised it from very high quality international institutions. So one of them was APG, who allowed us to disclose their name. But then we also have two sovereign wealth funds. We have a multi-manager, global multi-manager. Between those four, they contributed 680 million into the strategy. And they weren't there for the opportunistic returns. They believe in the secular long-term megatrend behind the sort of vacational hotel theme. And if we think about where else we're seeing the capital coming in, I think we're seeing everything from, let's say, rented residential. There's obviously been a very strong inflow of investment capital coming into that in the sort of build to rent segment, in the PRS segment, although there's very limited scale to buy any existing product now. We've obviously seen it in logistics. Both of those segments are up more than 20% investment versus where we were in 2019. But we're also seeing it in other segments. We're seeing it in senior housing on our front. I think there has been a bit of a divergence in terms of risk profile. So I'd say most of the capital is being deployed into the core plus segment right now. I think in the value add and opportunistic segment, there's still a bit of a disjoint, a bid-ask spread between buyers and sellers. I think that will sort of play out over the coming months and probably the next year. But we're seeing much more transactionality in the sort of the core plus segment that we are seeing in the value add and opportunistic segment. And I think that's also a change versus the great financial crisis, where we saw the investors coming in, even from 2014 to 2016, looking for opportunistic returns and distress, and that's really just not being the case right now. So I think we're definitely in a better place from an investor sentiment and investor flow perspective than we were before.
Yeah, that's really interesting, Rodrigo. I wanted to pick that up a little bit as well, David, and of course anybody else come in on this. But do we expect there to be more of an advantage in being a domestic-based investor rather than international capital because of the restrictions on travel? Do you see that as being an advantage at the moment, David?
I don't really, because I think that people have adjusted very, very quickly to alternative ways of making contact, alternative ways of doing diligence. And, it's one of the things that I kind of, again, think about how the travel industry and how maybe the hospitality industry is going to change after this, is that a lot of initial contact that was done by direct meeting, I think now is going to be done by video, because so many of these, everyone's gotten used to doing it. And while you need to have personal relationship to get a deal done, you don't need a personal relationship to see the first opportunity. And so I think a lot of that a lot of those first initial impressions and first initial are going to happen by video. That's a lot of travel that gets eliminated. These conferences, they're the hybrid model for conference, I think, is going to continue. People in the room, but then also having it done for those who can't participate. So you can choose whether you want to fly to a location or whether you want to participate. So at the margin, a lot of that is going to move. So that said, I don't think it advantages you being domestic or not domestic. Where it may advantage you being domestic versus not domestic, which has always been the case, is in times like this where there's uncertainty, it's very difficult to get a view of what's happening if you're not on the ground. And when things are going well, that's not as a big of a deal, because everybody kind of follows along the path and there's a consistent view of what's going to happen. But when you're in a moment when everything is up in the air about how is the impact of work from home going to be different in Spain and Portugal from what it's going to be in the UK or in France or the US, that's a very low, each market's going to be impacted differently. And that, if you're not on the ground really talking to those tenants, understanding how they're thinking, then you may try to take a very broad brush approach to what's a very local kind of decision. So I think that's where maybe being local is a bit of an advantage. And I want to pick up on what Rodrigo said, because I agree with him completely. And I think it surprised everybody, that there's been very, very little distressed sale outside of retail and people like Into, right, who've been forced to do this. There's been, and even Unibail have said, okay, we were going to cut the dividend rather than sell assets. So everybody has been, able to hold on long, and I think part of that is the government action. Keeping rates so low, it's easier to hold on to. You're not as forced to sell. So the government action has really, I think, reduce the amount of stress that's out there. So if you look at Spain, the deals that have been done in the middle of the crisis, a building sold on Velázquez, only 1/3 occupied, sold in the middle of the crisis to, I think it was Allianz or Zurich, at a 3.1% yield on expected yield when it's fully let. You've had Mercadona sold a package of assets. You have Eroski now with a package of assets. So if you have a supermarket, long lease supermarket, there was no impact for COVID. In fact, it probably got done at a tighter yield than if COVID hadn't happened. Building sales in Lisbon as well have been done at yields that are really quite attractive yields. So there's been very little distress. And the one shoe I think that people are waiting to drop, it's not a European thing, but it's a US thing, is the CMBS market in the US has a lot of assets in it that are underperforming assets, and they're now being special service. So people think that there might be some really distress coming out of the large CMBS assets done in the US. But so far, none of that's happened. And I think that's probably been the biggest surprise for people, is that there's so much capital out there and there's been so much government support that there's been very little distressed product available for the big opportunistic guys that's come out of this particular crisis.
There's a lot of discussion about what happens during the economic crisis as the government unwinds its support. Pedro, just from your perspective, is that a concern for you? Is that a risk as the government support begins to unwind? What then happens?
It's not a concern, but I would say that my expectation is that we are going to assist on a kind of wave of unpayment toward the banks, and so then the assets move to the banks, and as in the other crisis, ECB is putting pressure on the banks to get rid out of the assets much quicker than on the financial crisis, so that the banks don't have capital problems. And so my view is that we are going to assist in, I would say, 2 to 3 years, let's say, a moving of portfolios to come over to the market on distressed assets, both in commercial and residential.
Okay, and is that the same in terms of Spain as well? I don't know if anybody wants to pick that up.
The one thing that I think is pretty evident from this, because all the central banks have been singing the same tune, is that the withdrawal of support is going to be very, very long dated. There's a desire to reinflate the economy, and Jerome Powell has said he'll deal with inflation above 2% for a longer period of time because we're in such a long period of low inflation. And so I think, and you see it in other markets, the reflation trade is the trade of today's market, whether you're in the equity markets or whether you're in the fixed income markets. And so I think that's something you can look at in real estate. There's going to be more inflation for a longer period of time than I think we might ordinarily expected from the central banks, and this keeping policy accommodative for a longer period of time, I think, is going to be a fact that we'll all be dealing with. And so inflation is, if you're going inflation without in a growing environment, that's generally very good for real estate, which is why I think you're seeing so many people increasing their commitments and maintaining their commitments. Real estate is still a place where people want to be because hard assets tend to perform well in inflationary environments. And I think that's a fundamental core philosophy that a lot of investors are following. The one thing that worries me a little bit is, if you look at what the long bond rate in the U.S. has done over the last month, where the curve is steepening significantly. It's one thing, and again, the Fed's not worried because real rates are still quite low. But if with all this money printing, and the U.S. is going to do another 1.9 trillion, the deficit this year will be 2.1 trillion with a T dollars, and then Biden wants to follow it up with another 1.5 trillion package for infrastructure. So the printing of money, this whole new modern monetary theory where deficits don't matter anymore, is going to drive central bank thinking, and inflationary pressures can get out of control reasonably quickly. So that's my bigger fear. But if you are in an inflationary environment that's meaningful, where do you want to be? You want to be in hard assets, whether that's power generation, real estate, gold, Bitcoin. You pick your poison, but you're going to want to be in hard assets.
My question is, what is fundamentally changed over last year that will stay for the overall future in the real estate industry? Will retail really change, and we are seeing a new world, or we will skip out of our memory in 3 months' time, and everything will be as ever was?
I mean, it is very difficult to summarize, but I think that it is also a good opportunity. It is also a good opportunity to refocus. The companies need to try to understand what is going to happen. Big companies like us have to be near the customer, near the people that is going to live in our houses, understand their necessities, understand what are the new tools that we have in our hands today. I am talking about digital services. I am talking about experience. I am talking about, one market in which the real estate investors and managers do know who are their clients, what do they really need. Not only talking about the money, talking about the big discounts or whatever, also, but thinking very focusedly on the service that you provide, how you work together jointly with your tenant or with the people who is living in your house or co-working in your flex spaces, and setting the risks. Because what we see now is that real estate is not only having some bricks, making a space for people to live or to work. It is engaging with them, and in one way being their partners. This is how I think that we have to focus this. We have to think more in these people, more in the reality of the society, and this is to me the main challenge. And I say again, we have fantastic tools today to understand what is happening. We have a lot of information. We have never had this big amount of information of this big quality. We have the big data. We understand how our people is moving around, how our people is buying, how the people is living. So it is also a good moment of opportunity.
I mean, I don't think there's been any new trend created in the context of COVID. I think it's been an acceleration of trends that were either already in movement or were going to be moving forward over the coming years. I think even the hybrid model of offices that's been discussed here, there's a case to be made that over the next few years it would have happened anyway to some degree. And if we looked at the sort of trends that we've seen, obviously the big jump from logistics, from being let's say the ugly duckling in the room, to being the next core in most investors' portfolio. Retail, the continuation of the trends that we've already seen over the past few years in retail, rented resi, the increasing importance of that in countries like Spain, for example. And then ESG. I think ESG has been a key theme for a number of years now. But if I had to judge, I'd say probably over the last 12 months, we've seen a notable acceleration of the focus of investors and due diligence around ESG topics. And if I had to think about when we think about creating portfolio and buying assets, ESG is at the core of it, because if you want to future-proof a portfolio, you have to make sure that the ESG characteristics are right, not for today, but for 5-10 years down the line. And I think that's I mean, those are the trends that we've seen, and we think they're here to stay. And I think the other one that's already been mentioned is I think real estate has moved from being a very passive investment to being a more and more active operational one, where we have to continue as investors and as managers, we have to continue adding value to the tenants. And that's something which again is going to be here to is here to stay.
Thank you. We have one question from our Q&A that I particularly found it useful. And Alexandra asks, following the geographic core investment question brought by Rodrigo, and the uprise of Iberia as a region to include in investment intentions, is there any clear relation between Spain and Portugal for investors, in the sense that both countries are complementary in matter of risk diversification for international investors and funds? Maybe Francisco, do you want to pick up a little bit on that one? You know a little bit of both markets.
I think it's an interesting question, and it's not such an easy one to answer. I think both markets are quite different, and I think the scale of the Spanish market is one of the things that makes a huge difference. The scale and the liquidity that comes with that scale. I think there are different markets, even if you look at the profile of the residential market in Portugal and the profile of the residential market in Spain. They are very different in terms of product design, specifications, etc., etc. They were more different before, but they are still quite different. I do think that people tend to look at Iberia as a market, and I think that's a bit of a mistake. And I always think of many years ago there was a wave of Spanish investors entering into the Portuguese market. And they came with the same product conception and design that they had within their market, especially in the resi sector, and they did some mistakes in the way they delivered the product to the market, and they quickly learned, but the initial entrance was a bit on the side. I think people do think of Iberia as one single market. I think there are intricacies which separate them quite heavily. There are many different players which play across both markets, obviously, but I think they are separate. They have separate rules, and the market I think it's more closed, less transparent in Portugal, unfortunately, which is a huge hurdle when you look into a market for the first time. It's not as transparent. But yes, I do think that investors look at it as one single market, and I think and I agree that and we see that on a daily basis that it used to be a market in which you would also invest. Now it's a market in which you have to invest. So for the big portfolio managers, it's definitely something that they consider. Let me just take you quickly to the previous question, António. I think I agree with Rodrigo. It's more an acceleration than a different than something completely disruptive. I think the one exception is the residential market, in which I think there are clearly new trends that come with working from home, and I think that both Portugal and Spain, with the conditions that they have to attract foreigners to live in part or all of the year, I think it's a huge opportunity for both our countries. I think both the south of Portugal and both the south of Spain and all the coastal areas can have and should have, set up policies to attract people that come for 2 months, 6 months, whatever. We used to have a lot of those with people that were already retired, but I see no reason to expand those to people which are very active. I think the one hurdle is, of course, education of the children. But I think that this is also one which I'm sure will evolve over time, as you know, our kids are all studying online anyway, so maybe that will continue. And I think that's one of the sectors in which I see a lot of opportunity for the Iberian markets.
Thanks very much to everybody here for joining us. Really interesting to get that outlook on the Iberian markets, I think.